Let me also show you the live cattle one. About that. Live cattle futures. Go to the specs. So minimum 40,000 pounds live cattle, right? Deliverable. So settlement procedure. You can see here settlement. They have all these, like the CME feeder cattle in wait here. Not there. Have that open something. Yeah, this one. So this is also a live cattle futures contract. And here it live graded deliveries, right? And it says delivery days. Delivery may be made on any business day of the contract month and the first 11 business days of the succeeding month. So this month or within or to the 11th of next month. You can see here substitutions. All cattle contained in the delivery unit shall be healthy, no cattle which is unmerchantable, right? Weights of the cattle. And where to deliver. Delivery points and allowances. In Colorado, you deliver to any approved livestock yard. Iowa, Minnesota, South Dakota, deliveries shall be made at a discount of $150. So there must be some reason for that in terms of the charges and so on. Into any approved livestock yard. Kansas to again approved livestock yard like this. So they have defined where and when, how the deliveries can be made and where the deliveries must be made to. So you can read through. Like there's a lot of information, and actually if you go to the CME group and you, I think right at the bottom, you will find there should be somewhere that talks about education. So they have a lot of educational videos in terms of how to trade, what to look for, right, in terms of futures trading and for options trading. So these are things that you can take a look at. Okay, back to the question.
Well, when it comes to this, I'm sorry, just to get this clarified on commodity markets again. Yeah. Now, unlike these equity markets, money markets, and FX, like the what do you call this livestock or whatever the commodity. Now, as a medium of exchange, it's like the value is not easily what do you call definable, I would say. Now, when it comes to this commodities like these conditions and all, is it the responsibility of the exchange to see to that these standards are met, or like how do we ascertain that it is the particular stock that is getting delivered?
No, I think it's more than the responsibility of the exchange. I mean, there would be certain because you don't necessarily need to be a person who's trading on live cattle to go short on a contract, right? To agree to sell live cattle. But if by chance I told you you get hit and at the settlement, you are the person with outstanding who has agreed to settle, who has contracts that are outstanding at settlement date, then you must deliver. So then, if you must deliver, you have to find somebody who else who trades in live cattle and agree to the specifications and trade. If not, there will be penalties imposed.
Right. Right. Thanks.
Do the first three parts. Karen, second answer is wrong. So obviously, if that is wrong, you know what the right answer is. But yeah, second answer is not correct. Yes, Arthur is correct. Johan, yes. Yes. Okay. So, okay, yes. Yeah, so good. An oil distributor is trying to sell, right? He's an oil distributor. He's a person who's engaged in selling oil. And he plans to sell 100,000 barrels of oil in August. We're in July, right? And this data is as of July 2nd. Okay, so in August, he plans to sell oil. He wants to hedge against the changes in oil prices. What does he need to hedge against? What should he be scared of? He wants to hedge against changes in oil prices. When you say changes in oil prices, it's not about oil prices going up and down, right? He is only concerned about only one side of the transaction will make a loss for him. There is an oil price today, and if it doesn't go in his favor, it will have an opportunity loss for him, right? So, what does he want to hedge? In the possible decrease in price, right? Correct. So the possible decrease in price. So he should be scared. If he doesn't think that oil prices are going to come down, he doesn't need to get into a futures contract. But if he thinks oil prices are going to come down, then he should get into a futures contract today, because he may be right, he may be wrong, but he's hedging. He's hedging to make sure that he is not wrong. Okay. So should he hedge an expected increase or decrease in oil price? he should hedge an expected decrease. He thinks it might decrease. Otherwise, he won't get into the contract. If he thinks oil prices are going to increase by August, that's good for him. Why does he need an oil contract, right? But if he thinks oil prices are going to decrease by August, then he should get into a contract today. Okay. If he thinks it's going to decrease further. Should he enter into a short or long position? Should he enter into a short or long position? He should enter into a short position. Yes, because he wants to sell oil. He wants to sell oil, right? Forget about the futures contract. He wants to sell oil. So he wants price certainty in selling oil, right? So what is the underlying asset? Oil. What does he want to do? He wants to sell oil. So he gets into an agreement today to sell oil in the future. That means he goes short, right? So he enters into a short position. And how many contracts? How many contracts? He wants to sell 100,000 barrels of oil. Yes, 100 contract, because he needs to now get into a position where he's hedging 100,000 barrels of oil. If he wants to get price certainty on every single barrel of oil, then he needs to hedge 100 contract, because one contract is 1,000 barrels of oil. So he should be shorting 100 barrels of oil. He should be shorting 100 barrels of oil. Okay. Now try part 2. This is not March delivery, okay? So sorry about that. This is August. I had missed that dose. Here and here, just correct. Same question. Same question, right? I'll just put it to another page. Appropriate position means, because you had to figure out whether it's long or short, you already figured it out for the August contract. And he enters into this contract in July at the settlement price, okay, at the settlement price. So assume that the settlement price is a price that was actually traded in the market. This is simply for you to say, I could have said at the open price, at the closing price, at the high price, at the low price. I'm saying at the settlement price. Yeah. So he enters into a short contract at the settlement price. Also, part 1 is not there anymore. Increase or decrease? It's a decrease. Short position, 100 contracts. So 28, yes. But remember how many contracts? So what is the total? Look for the total. Sorry, is your part 3, I feel, is not correct. And again, are you using the total? I don't think so. It's not the total. Okay, now the answers seem to be right. Johan. If I Ravindu, I think the answer is not correct. Okay, sorry. Okay. So Timanka, correct. Looks okay. So we have market prices, we call the spot prices. So time of expiry to be 80. 83.38 and 85.38. Now, that's the spot price. And the price in July that he agrees to do this transaction at is 83.38, the settlement price, right? Assuming that 83.38 was the price that traded in the market, he is agreeing to do this transaction at 83.38, meaning in July, on the 2nd of July, he gets into a transaction, he gets into a short position to agree to sell oil, right? Short position means he gets into an agreement to sell oil at 83.38 in August. At 83.38 in August. Okay? So in August, when the contract matures, oil prices might be 80, 83.38 or 85.38. For the different scenarios, what are his profits and losses? Okay. First. And then from that, what are his total proceeds from the sale of oil plus the futures contract? Okay. If he had the futures contract and if he didn't have the futures contract. So firstly, let's look at the profit. The per barrel profit. What is the per barrel profit? At 80, if market prices, when the contract matures, is 80, is he better off or worse off? Is he better off or worse off?
Better off.
He's better off because he's gotten into a contract to agree to sell oil at 83. Market prices are 80, he's better off. He makes a profit of 3.38. There is a cash settlement to him of 3.38 per every barrel. There's a cash settlement to him of 3.38 per every barrel. Okay. And if market prices are 83.38, the profit per barrel is 0. And if it is 85.38, the profit per barrel is -2. Yes, -2. Meaning he has to settle somebody else. He has to give somebody else $2 per every barrel that he has purchased. So how many barrels has he purchased? How many barrels has he purchased?
100,000.
100,000. So for 100,000 barrels, what is his total profit? What is his total profit? 338,000. No profit and loss. And minus 200,000. Is that correct? If it's not, please let me know. Correct, right? That's his total profit. 200,000 has been taken out of his account. He's lost 200,000 because of this cash settlement. Lost meaning actual money has flown out of his account of 200,000. Okay. Now, that's his profit. So from the futures contract, assuming cash settlement, if oil prices were 80, he would have received 338,000. If oil prices were 83.38, no gain, no loss. But at 85, he would have had to pay 200,000. Now, assuming the futures contract are cash settled, but he's an actual oil distributor. So he has to sell oil. How much does he make from the sale of oil? How much does he make from the sale of oil in August from these three scenarios? He sells oil at market prices. So how much does he make?
8.338 million.
Yes. 8.338 million. 8.338 million comes from the fact that market prices are, no, not 8.338, not 8.338 million.
Sir.
How much?
8 million.
8 million. Market prices are 80. Correct. 8 million, right? 8 million. He sells oil at 80 rupees a barrel in the market, and he gets 100,000. He sells 100,000 barrels, so he gets 8 million rupees to his hands. In this situation, market prices are 83, so he'll get 8.338 million to his hands. And in this situation, he'll get 8.538 million to his hands. But because of the futures contract, what are his total proceeds?
8.338.
That is 8.338. Because from the sale of oil, he received 8 million. With the profit of the futures contract, in total, he has earned 8.338 million from this oil transaction. Here also, he has earned 8.338 million, although nothing from the futures transaction. Right? And here, 8.538 million, his profits have actually reduced, but in total, his proceeds are 8.338 million. So these are the three types of scenarios that can happen, right? The three types of scenarios that can happen. And what do you see? Not for a speculator, but for a person who wants to hedge, futures contracts give you price certainty. No matter what happens in the market in August, when I get into a futures contract today at 83.38, I know what my price is going to be. It's going to be 83.38. That helps me in terms of being able to manage my transactions, manage my costs, manage my sales, manage my profits, right? It gives me price certainty. When, for example, LIOC or CPC, if they get into a hedge contract, right? Now, we'll talk about, because the actual CPC oil hedging, that whole problem, that whole disaster that happened around 2008-9, that was in options. So we'll talk about options later, right? But why would you want to do this? This is to get price certainty. You know, 2 months from now, if you hedge, you know what your prices are going to be. And when you do that, you know how to manage the rest. How to manage the rest. This is especially true. For example, if, let's not talk about oil, but let's talk about some sort of manufacturer, right? If this is a part of their entire process, if you can hedge your raw material prices, right? You know, I have to buy raw material in 3 months' time. But now I know part of my raw material is oil. I've gone long on a contract at 83. Okay. I have to give let's say, I have to bid for a contract. I have to bid for a contract, and I need to know what are the prices that I can input. Now I know my oil price cost is going to be 83, no matter what happens in the market. So I can make a better bid. I know this is where, okay, I know this cost. So therefore I can make a better bid, right? Because my costing is certain. If I didn't do that hedge, I can give a bid today based on my expectations of oil prices, which is part of my total costing. So let's say, for example, I need 1 gallon of oil for this project, right? So 83.3338 or whatever. I know my raw material costs are going to be 1 gallon of oil, right? So $83.38, whatever, and then the other costs and whatever. Now I know 83.8. Because I hedged. And therefore, I can keep a margin on this and quote a price of 700 for my project. Quote a price of 700. I can keep a margin for this and quote a price of 700, right? If I didn't hedge and I just waited, I get this project. I know I'm going to get 700 as a revenue, but now because my costing is uncertain, my profit margin is uncertain, right? I don't know what the oil prices will be in August. Will it be 80? In which case I will get better profits. Will it be 85 or 90 or 100? In which case my profits are going to keep on coming down. For me to hedge that uncertainty, that risk, that is why a lot of people should get into or would get into futures contract. There are also speculators in the market. You need both for markets to function well, right? But for actual people who engage in these transactions, distributors, suppliers, right? This is the reason they would hedge to get price certainty. So yes, sometimes that hedge will not work. Like here, you could have made 8.538 profit, but now, not profit, you could have made sales of 8.538, but now your total revenue is 8.338 because of your oil contract, because of your hedging contract, right? But you knew that already. So therefore, you can incorporate it into your plans, right? So that's the advantage. Questions?
If you want to exit the contract before the maturity, how can we do that?
Okay. So if you want to get out of the contract before maturity, what you would do is you will enter into the opposite position. So if you enter into a short transaction, you enter into a long transaction for the exact same quantity. So in the clearinghouse's eyes, your transactions are cancelled out. Does that make sense?
Yes.
Vindhya, it should be the same settlement date, right? Otherwise,
Yes, absolutely. Same contract, same settlement date, same quantity. Yes. Sorry if that was not clear.
So it's not about selling the contract to someone else.
It is, right? So if you enter into a long position, you have agreed to buy. When you want to get out of it, you would enter into a short position and agree to sell. But in your clearinghouse, you have a long position and you have a short position for the same contract, for the contract expiring in August, for the same quantity. So in the clearinghouse's eyes, your contract has closed out. So there are no open positions.
so this not necessarily be in the same settlement price, right? You would make a
Absolutely not. Not
Awesome.
necessarily the same settlement price. So that's how you would, I think you were the one who was asking, right, earlier, if I remember correctly, whether if you keep on winning, can you get out of the contract? Yes. So that means you're getting out of the contract at a different settlement price. You're closing it out at a different settlement price.
Also, Vindhya, how does now futures contract doesn't have a separate contract price, no? The price is basically the price of the underlying asset. So
Not the price of the underlying asset in the market, right? So today, oil prices will be different. So what are oil prices today? If I'm understanding your question correctly. So, So crude oil price, WTI is 83 today, or Brent is 86, right? So this, and on second, we'll have to check out what the prices were on second. Who are buying oil only in the market, because CPC, LIOC will always want the best price. So will the other people. There might not be trades going through. So you need a set of speculators also who will be acting on different sets of information to really make sure that the market prices reflect the correct information. So again, at settlement price, right? That's I could have said high price or low price. Any of these prices that were there, I chose to say to do the trade at settlement price. 55, I think you need to check it again. It's a long position. Just double check it. Johan. It's okay.
Madam, here 500 means contracts, right?
Yes. 500
Then,
December con contracts.
then one contract is 5,000 bushels.
Bushels. That's correct.
Isn't it? Yeah.
And remember, it's in cents per bushel. So I am getting a different value. Yes. Okay. So yeah, Johan, also I think you should double check your value. Shivanka, yes. Correct. Correct. Okay. Very good. Niraj, are you taking the December contracts? I think the answer you're giving is probably for the, yeah. Should be correct. So a trader enters into a long position to buy 500 con contracts, right? 500 contracts that expire in December. So at settlement price, there seems to be a small mistake somewhere. Just double check it. At this price. Okay, assuming this is the actual price traded on the market, 420.40. So what is your contract? What have you done? You've gone into a long position. So you agreed to buy. You have gotten into a position that you have agreed to buy. Agreed to buy corn at 420.4 cents per bushel in December. Right? Agreed to buy corn at 400 or $4.2 per bushel in December. And you've done this for 500 contracts. So what is your profit or loss? Per one bushel, are you making a profit or loss? You've agreed to buy at 420. In December, the price is 400 cents. So have you made a profit or loss per bushel? Per bushel? You have gone long, right? So if you have gone long, it is the market price minus the futures price. What is the market price? $4. What is the futures price? $4.20.4. So per bushel, you've actually made a loss of 204 or 20.4 cents, right? That's per bushel. Each contract is 5,000 bushels. So loss of 0.204 into 5,000 bushels. For every contract, you've made a loss of, how much is this? $1,000, $1,020. So for your transaction, which is 500 contracts, you've made a loss of $1,020 into 500 contracts. I'm just putting, you don't have to do it like this, right? You just have to show me everything in one line, it's fine. But just to understand what's going on, you've made a loss of 510,000. Questions? That's your loss. You made a loss of 510,000. It's a huge loss, right? Pretty big loss. Even in US standards, it's 153 million loss in rupees. It's a huge loss. Okay. But now look at, when you get into this account, look at part 2. When you get into this transaction, I told you that the clearing house would want you to keep a deposit with them. This deposit we call the initial margin. If the initial margin is 10%, how much should you keep as a deposit with the margin account?
420.4 into.
Okay. 420.4 cents. So
Yeah.
4.024. Yeah.
Into 500.
Into 500? Is that it?
And into 5,000 also.
Okay. Into 5,000.
And 10% out of it.
And 10% out of this. But before that, can you tell me how much this is? This is the total contract size. 10% of that, no, you have to keep.
Yeah.
What is the total contract size?
$10,051,000.
10.051 million. Right? That's the contract size. How much do you have to keep as margin? 10% of that. So that's 1.0051. Any questions? So margin you keep today, right? It is an advance payment kept by the clearinghouse as a performance guarantee. It is not a payment on behalf of the contract, but it is some cash that you have to keep up today. You have to give up today, right? Remember, so that is one big difference that you see between forward contracts and futures contracts. In my forward contract example, when I agreed to buy the car in 3 months' time at 5 million rupees, you and I, we didn't keep any performance guarantees, right? We simply made an agreement. And at the end of the period, I have to purchase the car. You have to sell me the car, whatever the market price, right? But in a futures contract, because there is an exchange involved, there is a performance guarantee. You need to keep some money or you need to put that money upfront. It could be 5% of the contract size. It could be 10% of the contract size. It could be some other amount. But you had to keep some money out upfront. Okay? And here in this case, you're doing a contract of 10 million. For that 10 million, you're keeping 1 million money today as margin for a contract that is going to happen in December. Right? So you keep 1 million today with the clearinghouse for a settlement that's going to happen in December. So your holding period is from today to December. What's your return?
Do they pay interest for these margin accounts?
I don't think so. Sorry, no, I don't think so, but I have to double check it. Because on a daily basis, anyway, it gets mark to market, right? But I have to double check it. So what's the trader's rate of return? So this trader, as a percentage, what is his return? That's all it's asking. As a percentage, what is his return? What do you mean by return? You're on the right. 28, no. But for neither of you do I get the answer. Yeah. Divankar, that's correct. But I get a different answer. Using these figures are correct, right?
A 510,000 loss and 1.051 million margin.
0051, right? 0051.
Okay.
So Johan, return in percentages. Rate of return.
Excuse me, madam.
Yeah, I think it's 1.051.
Oh, is it
Yeah.
1.051? 4.0204 into
Madam,
500.
excuse.
Sorry, yes, go ahead.
That should be 4.204, not 4.02.
Okay, that's fine.
That is
Okay.
good.
$4.204. Sorry, so this is 10.51, is it? 4.204 into 500 into 5,000, 10.510. Then, yeah, your answers are correct. Tarinu, no. Johan, no. Rashmi, yes. Tiranka, yes. 28, no. So 28 and Johan, you all are just off by a factor. You're using the wrong base. Okay, what is your rate of return, right? Or return on investment. So what is your return on investment? You made a loss of 510,000. And you invested, okay, based on how much did you invest? How much did you invest? You invested not 10 million. You didn't put out money for 10 million. Remember, even in your margin accounts when we did it, you didn't put out money, right? Your broker gave some money and you gave some money. It was about how much money you gave. Here also, nobody's giving additional money, but how much money are you spending? 1 million, not 10 million. The contract size is 10 million, but you're only spending because you had to keep a deposit, 1 million. So for those of you who got 4.85, you're not dividing it by 10.51, you're dividing by 1.051 to come with a value of negative 48.52%. Okay. You have lost 50%, nearly 50% of your investment. You've paid 1 million as a deposit. You've given 1 million as a deposit and lost 500,000. That's how big your losses can be in futures contracts, right? Although you are transacting on a contract of 10 million, it doesn't matter. You're not even keeping 10 million, right? Your 10 million is just a hypothetical number. Your contract size might be 10 million, but that's just a hypothetical number. You're putting out money of 1 million and your money halves. You're taking home 400 odd because you've lost 500. So you're taking home only 485,000 rupees out of 1.05 million, right? And why does that happen? It again happens because of the concept of leverage. Leverage, right? Remember, I spoke about leverage when we spoke about margin trading and short sales as well. Here also there is leverage. Only 10% of your contract is required to be kept. This implies that you are leveraging yourself 10 times. You're leveraging yourself 10 times. Right? So your returns are amplified by 10 times. Your losses are amplified by 10 times. So to see this, now some of you all got the answer 4.85, right? What was that? If you had to keep your entire contract size as a margin with the clearing house, you make a 510,000 loss on a 10 million contract. If you had to keep that money, but you didn't keep that money, in which case your loss would have only been 4.85%. Right? But this is not what happened. You didn't keep that money. You didn't need to spend 10 million to buy this when you bought this futures contract. You need to spend 1 million when you bought this futures contract. And that's the danger of derivatives and futures contracts when you're trading on futures, because you are automatically leveraged, right? Every time you leverage, the volatility is based on a 10 million contract, but you're only putting money, you're putting a lower amount of money, and the type of losses that you can make are amplified, right? Because the losses or gains that you make are based on a 10 million contract, but the money that you kept, although it's kept as a deposit, it's money that you spent, the money that you've invested, right? When you're thinking of, when you're doing futures trading, you don't think of it as, I'm keeping this as a deposit. That's not the way you're thinking, right? You're thinking, I'm buying corn at 420 per bushel, and I'm spending 1 million. I'm investing 1 million. And I'm taking home 485,000. I've lost 48% of my money. 48% of my money. So the fact that I am leveraging means automatically in futures contracts, I am amplifying my volatility. I'm amplifying my return potential. If this was the other way around, if corn prices were 500 cents per bushel when the contract expires, right? Then I'm making massive profits. I'm putting up 1 million and I'm making massive profits. Okay. That's why speculators participate in this market. They can work on hundreds of millions of rupees worth, right? I can trade in oil, hundreds of millions of rupees worth of oil, but only put up as margin 1 million rupees. I'll buy hundreds of millions of rupees of oil, but I'm only putting up 1 million rupees. Yeah. If my bet is correct, if my speculation is correct, I can take home millions and millions of rupees, right? 200, 300, 400% of what I invested, but also I can lose all my money. That's the volatility of futures contracts, which is why, one, you need a central counterparty to make sure that there is performance, because there is high propensity to default, and especially because of the leverage factor. Questions?
Madam, if we take a similar analogy to this, now when the governments, when it comes to the money multiplier and money printing, this and relationship between money multiplier and SRR, isn't this the same kind of thing that is happening? Because lesser the SRR, the multiplier would be higher. No?
Higher, yes, and it would be an inverse relationship there as well. Yes, but it would be a slightly more complicated relationship. But
is there are multiple factors involved?
Because there are multiple factors involved.
Yes.
So imagine this opposite side of this position, the short, right? So this trader enters into a long position. Somebody's on the opposite side. There's a short party, right? The short party is making the opposite side of this transaction. He's taking home 510,000 positive when he entered into this contract, right? When he entered into this contract, he had to keep in the exchange also $1 million. The short also had to keep $1 million. But do you realize for the short, he makes a profit of 510,000? He makes a profit of 510,000. Do you understand that? The
Yes.
long makes a loss, the short makes a profit. For both, they have to keep 10% of the contract size in the exchange. So long makes a loss of 510,000 on 1 million rupees. Short makes a profit of 510,000 on 1 million rupees. He actually increases his gains by 48%. His return on investment is plus 48%. He puts 1 million rupees and takes home 510,000 rupees. So he is amplified 10 times in the opposite direction. But it is amplified because you don't have to keep the entire amount. So let's take the break. 10:30, we start on this question. Okay.
Just to know a small detail, ma'am, like this, when the figures and the amplifying nature of these futures, is this what Soros did with Thailand baht?
I mean, so I can't remember it offhand, but definitely he made additional profitability because of the amplification or the leverage that was there. Right. So he did exploit. It was more of a hedge fund transaction than a futures transaction. So I think they shorted the Thailand baht, right?
Right.
So, so it was not a futures transaction. It was not a futures market transaction, but it was a short. They thought it was overvalued and they shorted the baht. So, but they used, it was the same leveraging concept, because if you remember in shorting and in margin trading, your initial margin is 50%. 1 over 50%, your leverage 2 times. And you can do various things to leverage more times as well. So based on that, only he made that additional excessive profits. But I don't believe the futures market was involved in that.
He did it by shorting, right?
Yeah. He did it by shorting, if I remember correctly.
Thank you, ma'am. Thank you.
Excuse, madam.
Go ahead.
Madam, let's say, let's assume that they have ended the contract in December, and the buyer would pay 10 million, and he would have an opportunity loss of $510,000. So in that point, do we require to calculate a ROR, and is it dividing by the 510 by 10 million? Is that the way? Or how?
You mean as a percentage of his opportunity cost, is it?
Yes.
Like this? So here it's opportunity cost. This is not the actual profit and loss he made from the sale. He made actual profit of 338,000. And from the sale of oil, he got 8 million, right? And you're asking whether for this he should be using 8 million or his what he invested, right?
Yes, that is
For the futures contract, he should be using what he invested. To look at the percentage of the futures contract, he should be using what he invested.
Sure. That is what I need to clarify. Okay, thank you.
So take break 10:30.